You spend months researching index funds. You compare expense ratios down to the hundredth of a percent. You stress over whether to rebalance quarterly or annually. And yet, there's a single financial decision most people make in their 20s or 30s, one legal contract that statistically has more power to determine your net worth at 60 than every investment choice you'll ever make combined. It's not your 401k allocation. It's not your savings rate. It's who you marry. And here's what makes this uncomfortable. You probably spent more time researching your last phone upgrade than analyzing the financial psychology of the person you're building a life with. I'm Arya, and this is Arya Invest, where we explain how money actually works, not what you should do with it. This isn't relationship advice. This isn't about love or compatibility or whether someone makes you happy. This is about something we don't talk about enough. Marriage is a financial structure. It's a legally binding economic partnership that redistributes risk, combines balance sheets, and creates shared liability. And most people enter it completely blind to what that actually means. So today, we're going to look at the financial architecture of marriage, not to be cynical, but to be clear, because clarity protects you. When you get married, you're not just choosing a partner, you're choosing a financial co-pilot. And unlike a business partnership where you'd review credit history, spending patterns, debt levels, and risk tolerance before signing anything, most people enter marriage based on feelings, which makes sense emotionally, but financially, it creates a blind spot the size of your future net worth. Here's the reality. Marriage is a legal merger. The moment you say, I do, you're activating a web of tax codes, property laws, and liability structures that bind you to another person's financial behavior. If they spend, you absorb the consequences. If they accumulate debt, it affects your household cash flow. If they don't believe in saving, your compounding timeline gets derailed. You don't just share a life, you share a balance sheet. And this is where intelligent, financially responsible people make a mistake they don't even realize they're making. They assume love and alignment are the same thing, but you can deeply love someone and still be financially incompatible. And financial incompatibility doesn't announce itself. It reveals itself slowly over years in small, recurring conflicts that chip away at your ability to build wealth. Think about it this way. If you're someone who feels safe when you see your savings account grow, and your partner is someone who feels restricted by the idea of not spending money they've earned, you're not just different, you're operating from opposing financial belief systems. And no amount of compromise changes the fact that every dollar can only be used once. Let's look at what this actually costs. Not in a divorce, not in a dramatic blow-up, just in the ordinary friction of mismatched financial behavior. Say you're disciplined. You save $20,000 a year. You've done the math. Over 30 years, at 8% average return, that's over $2 million. You're on track. But your partner doesn't see money that way. They're not reckless. They just believe money should be enjoyed. A nicer car every few years, better vacations, eating out more often, small upgrades that make life feel better now. Let's say those preferences add up to $15,000 a year in extra household spending, not debt, just consumption. Now your household savings rate drops from $20,000 to $5,000. Run that same 30-year timeline, you end up with around $560,000. You didn't lose money in a market crash. You didn't get scammed. You just married someone whose financial behavior quietly redirected $1.4 million away from your future. The compounding you were counting on never happened because the capital never stayed in the system long enough to grow. And here's the part that makes this so psychologically difficult. You become the villain in your own household. Every time you try to protect your financial plan, you're the one saying no. You're the one creating tension. So eventually, a lot of people stop fighting. They accept the slower pace, they adjust their expectations downward, but it's not fine. It's just quieter. Now, that's the slow version. That's what happens when the partnership stays intact, but the priorities don't align. But there's another version of this story, and statistically, it happens to about 4 or 5 out of every 4 or 5 married couples. That version is divorce. The financial structure of divorce isn't just about splitting assets, it's about splitting efficiency. When you're married, you have two incomes funding one household, one rent payment, one set of utilities. That's leverage. When you divorce, you still have the same two incomes, but now they're funding two separate households. Your fixed costs don't halve, they double. Let's say a couple has built a net worth of $500,000 over 15 years. They divorce. In most states, that gets split, so each person walks away with $250,000. But that's not where it ends. Legal fees for a contested divorce can easily run $50,000 to $70,000 per person. Now you're down to $200,000. Then there's the house. If it has to be sold, that's 6% in realtor fees, plus closing costs, plus moving expenses. If you have to liquidate retirement accounts early to settle the division, you're triggering taxes and penalties. By the time everything settles, it's not uncommon for each person to retain only 30 to 40% of the purchasing power they had before. You're not just back to zero, you're 10 or 15 years older with half the time left to rebuild. And then there are the ongoing costs. If you're the higher earner, you may be legally required to pay alimony, sometimes for years. The legal term is often maintaining the marital standard of living, which means even though the partnership has dissolved, you're still financially responsible for funding the lifestyle the other person became accustomed to during the marriage. Now, this might feel harsh, and I know the immediate reaction is marriage is about love, not spreadsheets. And that's true. Marriage should be about partnership and trust. But here's the thing. Money is the #1 reported cause of relationship conflict. Financial stress erodes trust over time. If you want the relationship to last, you actually have to get the financial part right. The irony is this: by treating the financial side of marriage seriously before you're legally bound, you're actually protecting the relationship. You're removing the biggest long-term stressor. When two people are aligned on money, they stop fighting about the past and start planning for the future. But alignment requires transparency, and that's where a lot of partnerships fail before they even begin, because people don't ask the hard questions early enough. There's a term for this: financial infidelity. It's when one partner hides spending, hides debt, or lies about money. Surveys suggest that around 40% of people in relationships have hidden a financial decision from their partner. In most states, you can be held legally liable for your spouse's debt. If they run up a credit card you didn't know about, creditors can pursue marital assets. You're legally tethered to their financial behavior. So the question becomes, how do you avoid this? You treat it the way you'd treat any other high-stakes decision. You ask questions. You look at the data. You need to have the money conversation before you get engaged. Credit score, student loans, spending habits, savings rate. You're not looking for perfection. You're looking for alignment. You're looking for someone whose financial values don't fundamentally conflict with your own. And yes, this is where the prenuptial agreement conversation comes in. A prenup isn't a bet against the relationship. It's a form of insurance. It forces you to have the difficult conversations while you still trust each other. It lets you define what belongs to the partnership and what doesn't. It can protect assets you brought into the marriage. It can shield you from debt your partner accumulated before you met. A prenup isn't cynical, it's clarity. But here's what all of this actually points to. When you do get it right, marriage becomes one of the most powerful financial structures available. Two people with aligned values, living on one income and investing the other, can build wealth faster than almost any other scenario. You get economies of scale, you double your tax-advantaged savings space, you have built-in accountability. When one person is tempted to make an impulsive decision, the other provides perspective. A financially aligned marriage isn't just sustainable, it's a compounding machine. The goal was never to avoid marriage. The goal is to avoid a bad merger, to recognize that the person you choose to build a life with has more influence on your financial future than your investment strategy ever will be, and to treat that decision with the seriousness it deserves, not because you're cynical, but because you're clear. If this made you think differently about a conversation you've been avoiding, that's the point. Not to create fear, just to create clarity. Because the more honestly you can look at the structure of a partnership before you enter it, the better chance you have of building something that actually lasts. Thanks for watching.